What if tomorrow the dollar stopped being the world's main currency? We're not talking about it disappearing completely, but rather it becoming just one of several key currencies, much like what happened to the British pound in the past. For the last couple of years, this topic has been stirring up financial circles worldwide. The Chinese yuan is making dizzying climbs and painful plunges. Central banks from Warsaw to Ankara are buying up gold at a pace not seen since the 1950s. The BRICS countries are discussing the creation of their own payment systems at their summit. But what's really going on? Is the world truly abandoning the US dollar en masse? Or are we just witnessing another media storm, and the reality is far more modest? The facts point to some curious things, and they don't always match what we read in the headlines. Today, we'll break down what lies behind the word de-dollarization, how the dollar even became the planet's main currency, and why countries are now seeking alternatives. We'll see if gold and the yuan can realistically challenge its position, or if this is more of a political gesture without serious economic foundation. And most importantly, we'll understand how these global processes affect our daily lives. Imagine you're buying oil from Saudi Arabia, coffee from Brazil, or sending money from Kenya to India. In all these transactions, completely different countries and continents are involved, but there's one currency that appears in every calculation: the US dollar. But why does this happen? Why did the currency of one country, albeit a very powerful one, become the universal language of world trade? It wasn't always this way. Even at the beginning of the 20th century, this role was played by the British pound sterling. International trade was conducted in pounds, and pounds formed the basis of central bank reserves. The British Empire controlled sea routes, and London was the financial capital of the world. But two world wars changed everything. Britain spent colossal sums on warfare, incurred huge debts, and its economy was devastated. The United States, on the contrary, was only getting stronger. They supplied weapons to allies, their factories were running at full capacity, and their territory remained untouched. The turning point came even before the war ended. In 1944, in a small American town called Bretton Woods, while Europe lay in ruins, 44 countries gathered at a monetary and financial conference to decide how the post-war world would be structured. The delegates understood, without a stable international monetary system, post-war recovery would be impossible. And they agreed on a simple but revolutionary scheme. All national currencies would be pegged to the dollar, and the dollar would be pegged to gold, at a fixed rate, $35 per ounce. The choice was obvious. The US had the largest economy, the biggest gold reserves, and had suffered less from the war than European countries. Thus, the dollar became the anchor for the entire global financial system. Can you imagine one conference 80 years ago still determines in which currency countries buy oil and hold savings? And there are many such decisions that subtly influence our money. President Nixon announced what would later be called the Nixon shock. The US unilaterally canceled the convertibility of the dollar into gold. The Bretton Woods system collapsed overnight. It would seem the dollar should have lost its special status. But the opposite happened. In 1974, the Americans reached an unspoken agreement with Saudi Arabia. Oil would be sold for dollars, and the petrodollars would be invested in American bonds. Thus, the petrodollar was born. From the English petroleum oil, this scheme turned out to be brilliant. Any country that buys oil, which is practically all countries, must hold dollars. And oil-exporting countries return these dollars to the American economy by purchasing treasury bonds. But trust in the dollar didn't grow immediately. In the 70s, it was undermined by inflation. In the 80s, by debt crises in Latin America. Each time it seemed an alternative would emerge. But always in moments of crisis, investors returned to the dollar. Simply because the American economy remained the largest and most reliable. Gradually, the dollar acquired three fundamental advantages: trust, market depth, and financial infrastructure. When a crisis happens in the world, investors flee to the dollar. US Treasury bonds are traded for $900 billion daily. No other currency has such liquidity, and the SWIFT and CHIPS systems connect banks worldwide through dollar settlements. The result is impressive. Today, the dollar is involved in 88% of all foreign exchange transactions worldwide. Nearly 60% of central bank reserves are held in dollars. America gained what a French finance minister once called an exorbitant privilege: the ability to print money that the whole world accepts. But every privilege has a downside. And if for the US the dollar is an advantage, for the rest of the world it sometimes becomes a problem. Imagine you go to a store and they let you pay with pieces of paper you drew at home. America got this unique opportunity to buy oil, technology, and goods with dollars that it prints itself. A balance of payments crisis doesn't threaten them. They pay with their own currency, which the whole world is forced to accept. Moreover, the whole world effectively subsidizes the American economy. About 60% of all US dollar banknotes circulate outside the United States. That's almost $1 trillion in interest-free credit. But most other countries don't have such luxury. In economics, there's even a special term, original sin, which means that developing countries cannot borrow abroad in their own currency. About 70% of their external debt is denominated in dollars. When the national currency weakens, the debt burden immediately increases. The most painful moments come when the Federal Reserve changes its policy. A vivid example, 2013. The Fed chairman hinted at tapering the bond buying program. He didn't make a decision, just hinted. Investors instantly started pulling money out of developing countries. In 4 months, currencies fell by an average of 15%. India, Indonesia, Brazil, Turkey, and South Africa were hit particularly hard. They were even nicknamed the Fragile Five due to low reserves and high dollar-denominated debt. When the world needed dollars in 2020, the Fed opened so-called swap lines, agreements allowing other central banks to temporarily borrow dollars in exchange for their currency. But access to them was granted mainly to developed countries, US partners. Paradox emerges. The dollar is a global currency, but decisions about its supply are made by one national central bank, based on its own interests. In recent years, the problem has intensified. The Fed raised rates to 5%. This led to a record capital outflow. Sri Lanka, Ghana, and Pakistan were balancing on the brink of default. By the way, if you want to understand how this machine called the Fed works, we had an intriguing video on that topic. A link will appear somewhere here in the corner, also in the description below this video. I highly recommend it. But let's get back to our story about why countries are seeking alternatives to the dollar. It's precisely such crises, when decisions by one central bank wreck economies worldwide, that are forcing more and more countries to ask the question, what if we trade with each other, bypassing the dollar? This isn't anti-American policy, but an attempt to ensure against the risk of dependence on a single currency. And one of the oldest methods of such insurance is suddenly becoming relevant again. Central banks are massively buying up the metal that can't simply be printed. Imagine the scale of what's happening. In 2022, central banks worldwide collectively purchased 1,136 tons of gold, a record for at least 70 years. In 2023, the pace barely slowed, another 1,037 tons. So, over the last 2 years, central banks have been buying, on average, more than a ton of gold every single day. But the most interesting part is who exactly is buying gold and why. Let's take Poland. Adam Glapiński, head of the Polish Central Bank, openly announced plans to increase the share of gold to 20% of the country's reserves. In 2023, Poles bought 130 tons and increased their stockpile by more than half in 1 year. The motivation is obvious. Gold is an asset that cannot be frozen, blocked, or devalued by someone else's decision. Now let's look at China. The People's Bank of China long remained silent about its gold operations. Then suddenly, at the end of 2022, it started regularly reporting purchases. In 2023, the Chinese bought 225 tons, a record since the 70s. Turkey is an even more dramatic story. Despite a currency crisis and inflation near 80%, it managed to buy 148 tons of gold in 2022. Can you imagine? The economy is cracking at the seams, the lira is collapsing, and the central bank is buying gold. The authorities even launched a program to buy gold from their own population in exchange for lira. The logic is ironclad. If your currency is weakening and the dollar might become inaccessible, gold remains the last anchor of stability. But the most mysterious story is that of secret purchases. Experts counted about 400 tons of unreported purchases just in 2022. Who buys in secret? Correct. Countries that fear sanctions. Even the Central Bank of the Netherlands expressed it frankly. Gold is the perfect quiet haven. If the financial system collapses, gold will serve as the basis for a new system. If even the Dutch say that, what are they thinking in Ankara or Beijing? The modern gold market is a global financial machine. The London market trades 20 million ounces daily. That's over 600 tons of gold. But here's the paradox. Gold is great for storing value, but terrible for everyday settlements. Try paying for an oil shipment with gold. You need assay tests, transportation, insurance. Takes days. Therefore, central banks view gold not as a replacement for the dollar in trade, but as the last line of defense. When everything else collapses, gold will remain. And judging by the fact that purchases aren't stopping, many central banks believe this moment might come sooner than we think. But gold is defense. What about offense? Is there a currency that can realistically push the dollar aside in international trade right now? China thinks so and is actively promoting its yuan on the world stage. Sounds promising, right? But something strange is happening with the yuan. It soars to historic highs, then suddenly loses a third of its standing. To understand how complicated the yuan's fate is, let's go back to recent events. December 2023, Beijing. There's an upbeat mood in the offices of the People's Bank of China. Swift data has just come in. The Chinese yuan reached a historic high of 4.74% of all global payments, fourth place among the planet's currencies, surpassing the Japanese yen. Western media are scrambling to write about the rise of the Chinese currency and the threat to the dollar. Chinese state media is triumphant. The yuan internationalization plan is finally working. But the euphoria doesn't last long. By February 2024, the numbers start falling. By May 2024, the painful reality. The yuan lost more than a third of its standing, slipping 2 places in the ranking, even falling behind the Canadian dollar. What happened? How did the potential dollar killer deflate so quickly? Reality turned out to be more complex than ambition. Over 10 years, China turned the yuan from a purely local currency into an international player. In 2016, the International Monetary Fund included it in the basket of special drawing rights. It includes only 5 currencies that the IMF considers stable and important enough for world trade. By 2020, the yuan took 5th place on the global foreign exchange market. But the real strength of the yuan isn't in global rankings, but in the fact that the Chinese skillfully use their economic power. Want to trade with China? Be so kind as to use Chinese money. The result is impressive. Nearly half of all Chinese foreign trade is now conducted in yuan. Just 10 years ago, this figure was only 12%. Beijing is building an alternative financial universe. The CIPS system, China's answer to SWIFT. 1,400 banks in 100 countries are already connected. However, the volumes are still laughable. $60 billion a day versus $1.5 trillion for the American system. A gap of almost 30 times. The People's Bank of China is handing out swap lines left and right. 31 countries can now borrow yuan, totaling $600 billion. But there's a nuance. When the crisis hit in 2020 amid the pandemic, none of China's partners rushed for yuan. All of them, as one, rushed to the Fed for dollars. And that's a painful lesson. In a crisis, trust is placed not in promises, but in proven assets. Nevertheless, the first cracks in the dollar monopoly are appearing. In March 2023, France's Total Energies and China's CNOOC struck a deal for liquefied natural gas entirely in yuan. The amount is modest, equivalent to $80 million. But a precedent has been set. Trade between some countries and China is now conducted predominantly in yuan. These are the largest examples of practical de-dollarization of bilateral trade. With Russia, for example, over 90% of trade with China is now in rubles and yuan. And here we come to the yuan's main problem. China wants the world to use its currency, but it itself is not ready to fully open its financial system. While central banks can't agree among themselves, and the yuan remains a restricted currency, ordinary investors are looking for ways to protect their capital. Cryptocurrencies are one such path. An asset without a central bank that can make unexpected decisions. A paradox emerges. China urges abandoning the dollar, but itself doesn't allow the world to freely use the yuan. The result is predictable. The yuan accounts for just under 3% of global reserves. But what if they don't act alone? What if they combine the efforts of dozens of countries and create a network of alternative payment routes? That's exactly what they're thinking from Africa to Asia, and it's happening right before our eyes. Let's move to August 2023, Johannesburg. At the BRICS summit, leaders of 5 economic giants gathered. This time, they were joined by 6 new members: Saudi Arabia, the UAE, Egypt, Ethiopia, Iran, and Argentina. The main topic of the summit: how to reduce dependence on the dollar. In the final declaration, the leaders call for expanding the use of national currencies in mutual trade. Sounds revolutionary, but the devil is in the details. No one is talking about creating a single BRICS currency, despite all the media speculation. Instead, each pair of countries negotiates for itself. China with Brazil creates a direct exchange of yuan for real. India with the UAE, rupee for dirham. But the most interesting experiment is happening in Africa. Let's imagine a specific situation. A company in Ghana wants to sell cocoa to a Nigerian chocolate manufacturer. Just 2 years ago, this transaction looked like this. Ghanaian cedis are converted into dollars at a bank in Accra. Dollars are sent via SWIFT to New York. From there to Lagos, where they are converted into naira. Commission at every stage. Total costs reached 5% of the transaction amount. Today, the same exporter can use a completely new system. African countries created PAPSS, the Pan-African Payment and Settlement System. The exporter enters the amount in Ghanaian cedis and specifies the recipient's details in Nigeria. The system automatically calculates the exchange rate and instantly credits naira to the buyer's account in Lagos. The dollar is not involved in the operation at all. Savings can reach 3 to 4% of the transaction cost. For African businesses, this is huge money. By the end of 2024, 16 central banks and 144 commercial banks had connected to PAPSS. The system works with 8 African currencies and is actively expanding across the continent. Asia took a different path through central bank digital currencies. In the fall of 2022, for countries China, Hong Kong, Thailand, and the UAE, conducted an experiment called mBridge. Over 6 weeks, banks in the 4 countries conducted 160 transactions worth $22 million, using digital versions of their currencies. Imagine a bank in Shanghai instantly sends digital Yuan. A bank in Dubai receives digital dirhams. No correspondent accounts, no SWIFT, no delays for days and weeks. If such systems work on an industrial scale, they could bypass the entire dollar infrastructure. Simultaneously, bilateral agreements are multiplying. India opened special rupee accounts for 20 countries. In August 2023, Indian Oil paid for oil from the Emirates in rupees, not dollars, for the first time. Brazil and China agreed on direct settlements in national currencies. For the first time in decades, a network of alternative financial routes is being built simultaneously across the global south. From digital experiments in Asia to real payment systems in Africa, the world is trying to live without dollar monopoly. However, behind all these impressive initiatives lie fundamental obstacles preventing them from becoming a full-fledged alternative. And the main one is that, for now, the new systems don't talk to each other. Imagine a company in Kenya wants to pay a supplier in Brazil. Through PAPSS, it can pay partners across Africa. Through the Chinese CIPS with China. But to pay Brazilians, it will still have to convert shillings into dollars and dollars into reals. If the dollar is a universal bridge between any currencies, the alternatives are currently creating an archipelago of unconnected islands. The second problem, the network effect works against change. Surveys show that 78% of companies in developing countries prefer to invoice in dollars, even if the counterparty isn't from the US. Why? Simply because it's easier. The accountant knows how to work with dollars. The bank has established procedures, and the software is set up for dollars. Switching to new systems means retraining staff, replacing software, changing procedures. For a large company, this can cost millions of dollars and months of work. Most businessmen think pragmatically. Why spend time and money on experiments if the old system works? The third barrier, the volatility of global South currencies. Over the past 3 years, the Turkish lira lost 60% against the dollar, the Argentine peso 80%. Imagine you sign a contract in lira, and in 6 months your profit has melted away due to currency collapse. Most developing currencies lack developed derivatives markets, meaning financial instruments that allow hedging against currency risks. The rupee, real, and rand account for less than 1% of the global currency derivatives market. A vicious circle emerges. Companies don't want to work with unstable currencies, and the currencies remain unstable because they are little used. And finally, the most important barrier is time. The dollar system was built over 80 years. First Bretton Woods, then the petrodollar, then global financial infrastructure. Generations of bankers, traders, and regulators grew up in this system. The alternatives have existed for only a few years, and to push the dollar aside, they need not only to solve technical problems but also to win the trust of a whole generation of financiers worldwide. All these barriers can be overcome, but they explain why the revolution in global finance is a marathon, not a sprint. And for ordinary people, all these global processes mean very specific changes in daily life. And while central banks are buying gold and BRICS countries are building new systems, ordinary people are already feeling the changes. Let's start with the most painful prices for goods. It used to be simple. The dollar rises, all imported goods become more expensive simultaneously. Now the picture is more complex. Take smartphones. The iPhone is still tied to the dollar and gets more expensive according to the old scheme. But Chinese brands are increasingly selling for yuan. When the yuan strengthens against the ruble, these phones can become cheaper. Even when the dollar is getting more expensive, this creates new opportunities. Planning a vacation in Turkey? The lira's 60% drop made Turkish resorts several times more affordable. Those who noticed this first got an almost free seaside vacation. The car market is an even clearer example. European brands have disappeared from showrooms or become unpredictably expensive. But Chinese brands have flooded the market. And it's not just about politics, but also the fact that settlements in yuan allow them to maintain more stable prices. Even in grocery stores, everything is changing. Turkish tomatoes disappeared in winter. Suppliers couldn't plan prices due to lira fluctuations. Instead, Uzbek ones appeared. They agree in rubles, the price became more predictable. Even more important, your savings. Central banks worldwide are reducing the share of dollars in reserves. If the trend continues, the dollar could weaken in the long term. For those who keep all their savings in dollars, that's a risk. Therefore, financial advisors increasingly recommend currency diversification. The logic is simple. Don't keep all your eggs in one basket. Some in a stable currency for safety, some in currencies of growing economies for growth, a little in gold for a rainy day. But this is just the beginning. What will happen next? No one knows. But let's dream and imagine what the financial world might look like in 5 to 10 years. So, morning, 2033. A trader in Singapore turns on the terminal and sees an unthinkable picture. On the screen, oil prices are listed in 3 currencies simultaneously: dollars, euros, yuan. No one is surprised anymore that some oil is sold for Chinese money, some for European. The petrodollar is no longer the sole master of the energy markets. In such a world, the dollar is still the king of global finance, but no longer an absolute monarch. Its share in central bank reserves could have fallen from today's 58% to about 55%. And every such lost percentage means that hundreds of billions of dollars are flowing into alternative assets. The euro could have significantly strengthened its position to 22%, especially if the Europeans finally create unified EU bonds. The Chinese yuan could have made a real breakthrough, rising to 8 or 10% of global reserves, but only on the condition that Beijing dares to partially open its capital account to foreign investors. And gold could well have become the planet's 3rd reserve currency, reaching 10% of all reserves. The world would gradually have split into 3 currency zones with digital bridges between dozens of currencies. This is evolution without upheaval. But imagine a completely different development of events. 2027, autumn. CNN is broadcasting. Congress rejected the debt ceiling. The government shuts down for good. This time, something went wrong. Unlike all previous cases, where investors calmly waited for a last-minute compromise, now they no longer believe in a quick solution. China publicly dumps its dollar reserves. Saudi Arabia reviews oil contracts. Trading floors turn into chaos. Yields on U.S. government bonds jump from 4% to 7% in a week. Investors demand a huge risk premium. The dollar crashes by 20%. An alternative trigger: escalation of conflict around Taiwan. Washington disconnects Chinese banks from dollar operations. Beijing, furious, dumps its $800 billion in reserves and declares, "Want our rare earth elements? Pay in yuan or gold." In such a panic, the dollar's share could collapse to 45% in 5 years, and gold could soar to $5,000 per ounce. The BRICS countries would hastily launch a commodity settlement unit. Currency chaos ensues, but from it, a new, more fragmented order is gradually born. However, there is a third path completely opposite. Managers of a large fund look at reports and shake their heads. How could we have believed in the end of the US dollar? What could happen in such a scenario? All the dollar's main competitors stumble simultaneously. Italy left the Eurozone after another debt crisis. In China, the real estate bubble burst. The moment another global crisis hits, investors, out of habit, again massively flee to the familiar safe haven: US Treasury bonds. By 2030, the dollar not only preserves but strengthens its position to 65% of global reserves. Alternative payment systems remained niche tools for trade between allies, but not for serious money. The world ultimately chose familiarity over experiments. With such a development of events, in 5 years we would look back and think all our fears were in vain. Of course, one can endlessly fantasize about the fate of the dollar, but the truth is, No one, not economists, not politicians, not bankers, knows for sure what will actually happen. Perhaps reality will be completely different from any of our scenarios. Somewhere the dollar will yield positions, somewhere it will strengthen, and somewhere something completely unexpected will happen that we haven't even thought of. The only thing we know for sure is that the world is changing. And the dollar, which seems eternal today, was also once a novelty. Well, friends, that's the topic we ended up with. What do you think? Are you ready for the familiar financial world to change? And what would you do right now if you knew that in 10 years the world's currency map would look completely different? Be sure to write about it in the comments. I'm very interested to hear your opinion. Also, be sure to support us with a like, subscribe to the channel. It really helps us make new deep dives into economic topics. All useful links, as usual, will be under this video in the description. See you in the next episodes. Bye-bye.